Let's get into class. Y'all know? Does anybody know what the S&P 500 is? Let me know. Show of hands. You can drop hands in the comments. You can say I do. You can give you a guess on what it is. Let me know before we get started. I appreciate y'all. Let's go ahead. Let's double tap. We had 1,000. Let's double tap and get this thing going. Kendra says nope. Sammy J says nope. ETF. Yes, it's definitely an ETF. You can find it in ETFs. It's a stock. Kind of, sort of. I'm gonna break it down. I'm gonna explain. Shiva says yes. Okay, cool. So we kind of got a mix. Some people know what it is. Some people giving guesses. Some people are kind of familiar. Sosa want me to enlighten them. I got you. Crypto is not crypto. What is an ETF? We'll get into that a little bit. I'll do a video on that soon too. So all right, cool. So everybody it's kind of mixed. So let me break it down a little bit for y'all. And if I need to, I'll bring out the good old handy dandy whiteboard back there. But the S&P 500. Let me give y'all like this simple breakdown. So and to help y'all understand. So S&P it's like the S and the P stands for Standard and Poor's. Okay, all that is just a financial rating system. Okay, if you look that up, that's what it is. It's a financial rating system. Okay, so the S&P 500 is really just a rating of the top 500 companies in the U.S. So what the S&P 500 really is, or what it really boils down to, is it's an index. It's something that tracks something, right? So the S&P 500 is an index that tracks the top 500 companies in the U.S. That's why they call it the S&P 500. Okay, so whenever you hear somebody say the S&P 500, that's what they're referring to. They're referring to this index that tracks the top 500 companies in the U.S. Okay, so let me give y'all an example of some of those companies. If you have an idea of what some of those companies are, drop them in the comments. I want to see what you think. What do you think are the top 500 companies? Just name some that come to mind, and I'll let you know if it's part of the S&P 500. Go ahead and drop that in the comments, and then I'll let you know. All right, I'm bringing up the whole list. That way I don't miss anything. So we got a bunch of people saying Apple, Netflix, Facebook, Walmart. We're going to see. I believe Walmart is in there. Google, Nike, Microsoft, absolutely. Right? These are some big companies, right? Whenever you think of like the top companies in the U.S., McDonald's, whenever you think of the top companies in the U.S., right? These are some of the companies that we think about. So let me get to the holdings real quick. Tesla just got into the S&P 500, and I'm gonna talk about that a little later too. All right, I'm gonna talk about that a little later too. NASDAQ. So NASDAQ is a totally different index. IBM might be in there. But let's look at exactly what's in here. All right, I'm gonna give y'all the top 10 that's in the S&P 500. So a lot of y'all already said Apple. A lot of y'all already said Microsoft. Amazon. Why didn't nobody say Amazon? I know a lot of y'all shop on Amazon. A lot of y'all get stuff from Amazon. Why nobody said Amazon? Facebook. I seen Facebook. I seen Google. Okay, Berkshire Hathaway. Johnson & Johnson is definitely in the S&P 500. Tesla. Nvidia, that's a chip company. They make chips for cell phones and different things like that. JP Morgan, right? All right. We can't forget about these banks, these big old banks that's in our economy. All right, that pretty much run the whole country, right? Banks control everything, to be quite honest. Let me see if I can pull up the whole list. It's only showing me the top 10. Hold on. Chase, I'm pulling it up right now. American runs on Duncan. All right, so here we go. I'm going to pull up the whole list. I'm not going to go through all 500, but, you know, I had to do the top 10 at least. So, boom, we got 3M. We got Adobe, Advanced Auto Parts, Aflac, AIG, Alaska Air Group. I'm just naming something that y'all might recognize. AMD, American Airlines, AT&T, AutoZone, Bank of America, Bath and Body Works, BlackRock is another big bank, another investment company. Let's see. Caesars Entertainment, Capital One, CarMax, Caterpillar. Let me see what else we got here. Charles Schwab, another big bank, Citigroup, Cisco. Let's see, CVS. Okay, pretty much all these companies that we all know of and we think of. Shein, Shein. I don't think Shein is on here. I don't know. Dollar Tree, Dollar General. Right. Let me see if Shein is on here. Let's see. I don't think it's on here though, because I don't think that's a U.S. company. Nah, it's not on here. Okay, Southwest Airlines, Starbucks, T. Rowe Price, T-Mobile. Okay, big companies, Twitter. Okay, all these companies. Tyson Foods is on there. Ulta Beauty is on there. Under Armour. All right, Verizon Wireless, Walmart, the Disney, the Walt Disney Company. Nobody said Disney, right? Yum Brands, that's Pizza Hut and stuff like that. Okay, Taco Bell, that type of stuff. So it's a whole bunch of companies that we know, that we love, that we go to each and every day. That's inside the S&P 500. So what most people don't know, Estee Lauder. Estee Lauder might be under another company, kind of like Yum Brands controls Pizza Hut and Domino's and all them other ones. Ralph Lauren is on here. Public Storage is on here. Okay, these are big companies, y'all. These are big companies. So a lot of y'all named them all, right? Which is good, because these are companies that we use on an everyday basis. Okay, so let's talk about NASDAQ. NASDAQ is actually a part of the S&P 500. Wow. Okay, but it's also its own index. So Sosa said NASDAQ. You're right. NASDAQ is part of it. NASDAQ is part of the S&P 500. Kraft, Heinz, Kellogg's, Johnson & Johnson. Big companies. So what's great about this is that when you invest in these type of the S&P 500, are there any insurance companies? I am pretty sure. Let me see if I can find any. Let me see. Globe Life is on there. Let's see if I see anything else. Here, let me do it the politically correct way, or the way that you do it on the computer. You got to hit Control F and then type in what you're looking for. Life and health insurance. There we go. I already named Aflac. Let's see if anything else that y'all can recognize. I just said Globe Life. MetLife is on there. Y'all ever heard of MetLife? Prudential is on there. Okay. But boom, that's pretty much it. That's pretty much it for the insurance companies. AIG is on there. Allstate is. I didn't see Allstate. No Allstate. Oh, yes, it is. It is on there. ALL. It's not under life insurance. It's under property and casualty insurance. Wow. So Allstate is on there. So like really just think of any company, like think of any big company that's in the US that is going to be on here. Y'all, thank y'all. Sherry, thank you for the roses. I appreciate that. Thank y'all for the likes. We already at 5,000 likes. Wow. My goal is to get to 10,000 by the end of this, by the way. So thank y'all so much. We already halfway there. So yeah, so that's what's so great about investing into these indexes, specifically the S&P 500, because what most people don't know is the S&P 500. This is one of the keys. This is one of the gems. All right, I got 3. This is one of them. So the S&P 500 is like the gauge. It's like the base index for everybody in the investment world, right? Some of the, like, three of the first indexes that people look at are the NASDAQ, the Dow, and the S&P 500. S&P 500 is one of those that everybody looks at. It's one of the most invested funds of all times. It's one of the most invested indexes of all times. It probably has the most assets under management of any other fund or index out there, right? That's how, like, important it is. That's how many people look at it and use it to justify and to look at the market and understand the market on a daily basis. That's how important it is. So that first gem is really that it's the overall gauge of how the market is performing, right? So if the market is up, or let me rephrase that, if the S&P is up, if the S&P is doing well on that day, that generally means that the entire stock market is doing well, right? If the top 500 companies are up, are green, right, have a positive day, then that means the overall stock market is going to have an up day, because guess what? Most of the big companies are also in some of these other funds and other indexes because they're so big, right? Because they're so reliable. They have such a large market cap. That's why, people use it. When the stock market or when the S&P 500 is performing bad or is not doing well, then people will look at that and say, all right, well, the stock market is not doing well today. They gauge pretty much everything off of the S&P 500. That's what I want y'all to understand. The S&P 500 is the gauge of the overall market because it contains 500 of the top companies in the U.S. All right. If you learned something, double tap just now. If you learned something, double tap just now. OK, so, and do me a favor, put that in the comments so that people that join in later can see that. Put that in the comments so that people that join in later can see that. OK, so the first gem, or the first thing I want you to get from this live is, number one, that the S&P 500 is the overall gauge of the performance of the stock market. Okay, somebody put that in the comments. The S&P 500 is the gauge of the overall performance of the stock market. That's what people use. That's what experts use. That's what everybody uses, right? To gauge the performance of the stock market. Okay, double tap if you learned something. Double tap if you got it. Let's get to 6,000 likes. We have 5.8. That should be easy. Just double tap for like 5 seconds. Double tap for like 5 seconds. S&P is the gauge of the overall stock market. Absolutely. Absolutely. Thanks, Mookie. Kimja, thank you. Shiva, thank you. Erica, thank you so much. Cool. So let's move on to gem number 2. Let's move on to gem number 2. Okay. So it's all good. I got you. I know what you mean. I spell stuff wrong. I say stuff wrong all the time. One of the words that I say wrong, or that a lot of people try to correct me on, is when I say fidelity. I don't know why I say fidelity. Like, that's just how I say it. That's how I've been saying it my entire life. So I'm gonna keep saying fidelity. That's just how I say it. But people gonna keep correcting me on it. But y'all know what I'm talking about, right? Just like I know what you're talking about with gauging the overall stock market. So let's get to number 2, gem number 2 on the S&P 500. So a lot of people do not understand this concept. All right. And I understand, because it's not taught in school. It's not something that the everyday person will learn or take the time to learn unless you really, in this space. So the gem number 2 is this. The S&P 500, that's a Georgia in you. Yeah, that's for sure. That's for sure. The S&P 500 contains 500 companies. Y'all know that part, right? Okay. But because it's an index, you don't have to invest. It's not like you're buying 500 individual companies. Okay. What do I mean by that? Because let's just look at the top 10. Let's just look at the top 10. Okay. Let's just look at Apple. Or, matter of fact, let's start with Google. Because have y'all heard about the stock split with Google? Google's gonna do a stock split. Some of y'all I told y'all about inside my group, but and others probably see my video. But Google is doing a stock split here. Why? Why are they doing a stock split? Because the price is so high, right? It's a $3,000 stock. And it's been trading around, pretty high for a long time. So why do they want that to happen? Let me tell you why. Yeah, the shares, they're going to do a split. It's going to be split. It's going to be divided by 20, basically. So it's going to be about $150 per share July 15th. All right. But why are they doing that? Why are they doing the split? Because their stock is expensive. Nobody is, or not many people are able to buy it. Okay. Which means they don't have a lot of volume, right? Or a lot of money being invested into the company because not a lot of people are able to invest in it. So what do? They lower the price. They do a stock split. They cut it in half. Okay. Why do I say that? Why do I say that? Because, yes, found out from you and purchased one share, patiently waiting for the split. Hey, that's amazing. You're going to get 20 shares off of that one share. Okay. You're going to get 20 shares off of that one share. Hey, Kendra, I'm going to answer that question after this because that kind of goes into what I'm talking about right now. Okay. About what exactly does the index keep track of? Okay. So why do I say that? Why is Google doing a split and why do they want their price to be lower so that more people can invest in it? It's the same concept when it comes to the index and to the S&P 500. You're not investing into 500 individual companies. Okay, because if you invested in the Google by itself, it's going to be $3,000. If you invested in the Amazon by itself, it's going to be about $3,000, $2,000, right? If you invested in Microsoft, it's going to be about $300. If you invested into Nvidia, that's another expensive stock. JP Morgan, that's another expensive stock. Okay, all of this stuff adds up. Berkshire Hathaway, I forgot if they did their split or not, but it's an expensive stock. Tesla is an expensive stock. You're gonna be putting up a whole bunch of money to invest into these things, okay, individually. What's so great about the S&P 500 is you can get access to all of these $1,000 stocks, multiple $100 stocks for one single price. You get access to 500 companies at one price. Okay, so like for instance, okay, SPY is an ETF that tracks the S&P 500 or that mimics the S&P 500. All that means is that it basically has the same companies as the S&P 500 inside of its ETF. Okay, so let me break down what an ETF is before I get going because I know that's going to hold some of y'all back. So an ETF is an exchange traded fund. Okay, it's a fund that has a basket of stocks, kind of like the index, like the S&P 500 has 500 stocks inside of that index, or is the index that tracks those 500 stocks. So when I say the index is tracking, all it's doing is just mimicking the price action or mimicking what goes on with those 500 stocks. And there's other ETFs with different names that do the same thing. Okay, I want y'all to understand that there's other ETFs that track the S&P 500 that do the exact same thing. So if you get like SPY, for example, that's an ETF that tracks the S&P 500. Another one is VOO. That's an ETF that tracks the S&P 500. If you buy those two ETFs, you're basically buying the same thing. There's no difference between the two. They both track the same index. So you're going to get the same return no matter which one you invest in. All right. So that's why we have to be knowledgeable about what we're doing. That's why we need the financial education. That's why we need stuff like this so that we can know exactly what we're doing. Because most people, what they'll do, or what I've seen happen is people buy SPY and then they'll turn around and buy VOO thinking it's something different when in reality it's the same thing. So I wanted to get that clear first. Okay. So yeah, that's the ETF. Okay. That's the ETF. What's up, Vic? What's going on? Glad to see you. So that's the ETF. Now, you won't have to buy all 500 of the stocks individually. You're going to be able to get access to it for one single price. So, for example, you can buy Google, Apple, Amazon, Facebook, all these companies, Tesla, okay, for $440 right now. That's how much the cost of the SPY ETF is right now. So you can get that for $440. Okay. And you don't even have to get it for that. Most of these apps or investment platforms allow you to buy fractional shares. So you can get it for $100. You can get it for $20. You can get it for $5 in most cases on with some of these ETFs. Okay. I mean, with some of these platforms that you use to invest. All right. So you don't have to buy these individually. That's the second gem. You're not buying them individually. You don't need millions and hundreds of thousands of dollars just to invest into the S&P 500. Okay. You can buy it for one single price and get access to all 500 of these stocks at one time. Okay. Does that make sense? Let me know in the comments. Does that make sense? And then drop gem number 2 in the comments as well. Drop gem number 2 in the comments as well. Okay. Drop gem number 2 in the comments as well. That you do not have to buy 500 stocks. Okay. You can buy all 500 for one price. You get access to all 500 for one price. That makes it easy for normal people like me and you. Oh, what happened to my picture? That makes it easy for normal people like me and you to start investing. Because we don't need a bunch of money to get started. We can get started with $150, $100 a month, $50 a month if we need to. Okay, so that's gem number 2. That's gem number 2. Okay. Let me see. Let me go back to the question. Y'all double tap if you learn something. Double tap if you learn something. Let's get it to 8,500 likes. We're at 7.8 right now. Boom, boom, boom. I answered that question. Yes, found out from you and I purchased one share. Yep. Thanks for the breakdown. You got it. Anyone on here young, please start investing today. I'm 43 and just started in 2020 due to the unknown. Exactly, right? If you young, please take advantage of your time. That's your key to wealth, your time. You have more time than most people. So get started investing. The earlier you start, the more you will have. The earlier you start, the better off you'll be. Listen to this man. His simple video regarding Roth IRA changed my life. Thanks again, Chief. You are welcome. You are welcome. I'm glad to be able to help you and change your life, right? We're on a mission to impact a million people, y'all, and we well on our way. Boom. Okay, so y'all dropping gem number 2 in there. Y'all dropping gem number 2 in there. All right, as far as investing, so Mookie asks, is Robinhood good? Robinhood is cool for beginners. Like if you want to learn the process of investing or you want to learn the process of buying and selling a stock, Robinhood is good. Now, if you want to go ahead and get started long term, which is what I recommend, okay, everybody needs to get started long term. Everybody needs to get a long term investing strategy, a part of their wealth strategy so that they can have something to show for all this hard work that they put in right now. That's what I highly recommend. There's 2 accounts and there's 2 platforms that you can get started with doing this. Okay, number 1, my all-time favorite is M1 Finance, and I can do a whole nother live on this. If you join my group, I can talk about it. If you want to join our group, it's completely free, y'all. It's no charge to join my group. That's at the link in my bio to join our community. It's called the Money Mindset League. I can talk about that in there. If you have any questions, I can answer questions in there. All right. So number 1 is M1 Finance. The reason why I like it is because it automates the entire process. Like you can literally set it and forget it. The main problem with people and money is their emotions. They let emotions get in the way. They let one thing get in the way of them being able to invest for the long term, right? They let one little emergency or something, birthday, holiday, something come up, and they make the decision to be like, all right, I don't need to invest for this month. So let me stop my investments and let me stop investing every month and do this. And then they never end up doing it. Okay. So one of the things that we need to start doing is eliminate the emotion out of the equation so that we can not have to make that decision. The less decisions that we make with money, the better off we will be with money and the more money we'll have. That's besides this whole message. If y'all don't learn anything tonight, that's what y'all need to learn. Okay. If y'all don't learn anything tonight, the less emotion involved with money, the more you will have. The less emotion involved with money, the more you will have and the better off you will be. All right. Trust me when I say that. The better that you can automate your systems and automate paying bills and investing and saving and things like that, the better off you will be. Trust me, it's going to save you a lifelong of stress. That's what it's going to save you. All right. If y'all don't get nothing, remember that. Okay. So that was platform number one. Platform number two is Fidelity. All right. We talked about Fidelity. All right. Fidelity is number two. I like Fidelity. It's very simple to get started. With M1 Finance, there is a $500 initial deposit, but just save the $500 and then put it in there, right? You're going to save $500 anyway if you do the long-term strategy. So just go ahead and do it, put it in there, and then let it start working for you. With Fidelity, there is no $500 initial deposit. You can get started with any dollar amount, $10 if you wanted to, right? Just to get started. The only thing with Fidelity is you cannot automate the investing side. Like you can automate putting money into the account, but you cannot automate the investing. All right. So those are my two favorite accounts. Let's get to gem number three. Y'all ready for gem number three? Let's get it to 10,000 likes because we at 9.3 right now. We get it to 10,000 likes. I'm going to drop gem number three. Yeah, Fidelity is great, especially on the customer service side. So let's get to 10,000 likes, y'all. And then I'm going to drop gem number three. That's the final gem. And then, I'll answer any questions before I hop off. So this is gem number three on the S&P 500 that most people do not know. So you're probably not going to find this on Google. All right. Most people probably not going to tell you this. I don't know why. Or most people probably don't know. But I found this out just from doing research and looking myself. So y'all going to get a third gem. That's going to be crucial. And that's really going to like give you some peace of mind, right? That's going to really help you when it comes to investing, because a lot of people are worried about, what they're invested in, and what if it doesn't perform well, and what if it does bad, and is it worth it, and is it going to grow, and is it going to perform, and is my money actually going to earn interest? All right, that's one of the mental barriers that a lot of people have when it comes to investing. All right. So boom. Yeah, we at 10K. Boom. So let's get to this third gem. Okay. Like I said, a lot of people don't know this, but here it is. It's like top secret, y'all. Yo, share this with everybody once you hear this. But anyways, this is going to give you peace of mind. Okay. So gem number three, be ready to write this in the comments. The S&P 500 is so great that it's regulated. What do I mean by that? I mean that the S&P 500 has high standards. So what they're going to do is, if a company is not performing like it should be, right? If it isn't growing like it should be, if it isn't performing like it should be, if they aren't making profits like it should be, if it isn't making its investors money like it should be, they're going to remove it and replace it with a company that is doing all those things. Did y'all just hear me? Did y'all just hear what I said? They're going to automatically, it's a board of directors that manages this manages this index and regulates it strictly. If they are not performing up to the indexes, the S&P 500 standards, they're going to remove that company and replace it with a new one. What does this mean? You do not have to track it. You do not have to look at it. You don't have to worry about it, because their job is to make sure that this fund performs so that you, the investor, make money and continue to invest into this ETF or into this index fund. Okay? You do not have to worry about what is the next best stock. Because guess what they did with Tesla? They seen Tesla was on the rise. They seen Tesla was making these profits. They seen that it was something that was great. And what did they do? They removed ExxonMobil and replaced it with Tesla. ExxonMobil used to be like one of the staples of our economy back in the day, right? Back when oil and cars were first created. Okay. ExxonMobil used to be the big thing walking on the S&P 500. But they don't care. They're going to remove it and replace it with something that's performing, and that's going to be the future. so that you don't have to worry about it. Did I have to do anything special when ExxonMobil got kicked out? No. Did I have to do anything special when Tesla replaced ExxonMobil? No, they did it for me. All I did was just reap the benefits. The S&P 500 did about 23% last year. Inflation has done 7%. I won. We won. If you invested into the S&P 500 last year, you beat inflation without having to do anything, without having to worry about a stock, without having to make adjustments to your portfolio, because they automatically did it for you. I don't think, do y'all understand? Do y'all see how powerful that is? Or am I the only one? Do y'all see how powerful that is? Let me know if y'all see exactly how powerful that is. Because I believe that's going to take a lot of stress off of you about what you're investing in and how to invest in it and what you should be doing. Does that help some of y'all a little bit? Does that relieve some of that stress or the worry away from investing for some of y'all a little bit? Let me know. Let me know below. Let me know in the comments. Because that is extremely, extremely powerful. Was this about the AMC and Doge? Nah, not at all. Okay, so that was gem number 3. I've seen a few people already put it in the comments. If you haven't put it in the comments, put it in the comments now so that you can remember it. When you write things down, when you type things down, it just helps you remember it, especially when it's coming from you. Especially when it's coming from you. Okay, so Kendra, it depends. It depends. That's a great question. So it depends. So last year the S&P did 23%. That means if you put $10,000 into the S&P, okay, you just made $2,300 in 1 year. Okay, that's big results. And most people don't see that in 10 years. Okay, but if you invested in the S&P 500, you had $10,000 invested. That's a $2,300 gain if it did 23%. Okay. Now, long term, the S&P 500 over the last 100 years has averaged about 10% per year, which is really good. Because remember, inflation on average is about 2%. So we need to be beating inflation when we invest. When we invest into things like the S&P 500, when we invest into things like real estate, when we invest into things like businesses, when we invest into things like crypto, we need to be beating inflation, because inflation is the secret tax. It's taking money from us without us even knowing it. Okay. I'm doing another video on that. Okay. Just breaking that down. Okay. Basically how inflation is robbing you without you even knowing it. Because if you had 10,000 sitting in the bank last year, we all heard about inflation and what inflation is doing currently is about 7%. That means you just lost $700. That means your 10,000 is now worth $9,300. Okay. You can only buy $9,300 worth of stuff today. What used to be able to buy you $10,000 worth of stuff is only able to buy you $9,000 and $9,300 worth of stuff today if you got 10,000 just saved in the bank. Now, I want to make it clear that, you need money saved. You need liquid money. Okay. But you should be investing to beat that 7% or that 2% on average, 2 to 3% on average for inflation. Okay. So double tap if you learned something tonight. Those are the 3 gems. Those are the 3 gems. Those are the 3 gems. Number 1, you don't invest. I mean, the S&P 500 gives you access to 500 companies at once. You pay one price. You don't have to invest into 500 different companies. Gem number 2. I'll take it. I'll take it. Gem number 2. Okay. The S&P 500 index. What was gem number 2? Y'all remind me. I forgot for a second. I know gem number 3. Boom. Yeah. The gem number 2 is the S&P is the the gauge of the overall market. And gem number 3 is that it's regulated. They will remove bad companies and replace it with new ones. They replace it with new ones that are performing better. Yeah, my bad. 1 was the gauge of the overall market. Kendra, yes, that's the real gem. If you don't take nothing else from this, the less amount of emotions you have with your money, the more successful you will be with money. If you don't get anything else, okay. But those are the 3 gems. Number 1 is the overall gauge of the market. Number 2, you get access to 500 companies at once. And number 3, it's regulated. They remove companies that's not performing and replace it with companies that are. That my friends, is everything that you need to know about the S&P 500. Okay, those are 3 gems about the S&P 500 that you need to know. All right. So again, double tap if you learned something. Let's answer some questions. I got 15 minutes to answer some questions, y'all. Let's get to some Q&A. Ask some more questions about anything about the S&P 500, about investing, anything. I'm gonna answer it right now. Benyacita, what's up? How you doing? Welcome. Glad you are here. You're here right at the right time. All right. Would y'all like this recording? Would y'all like this replay? Was this knowledgeable? Was this educational? Is this something that you would want to look at again or listen to again? Y'all let me know in the comments. Let me know in the comments, and then I can figure out how to get this to y'all. I can figure out how to get this to y'all. Y'all let me know in the comments. Would y'all like the replay? I've lost a substantial amount lately with mutual funds and stock. You think it'll get better? Yeah, you have to be a long-term investor, and it also depends on what you invest in. Okay, if you invest in, I don't know, like if you invest in the S&P 500, okay, just keep investing for the long term. You cannot let the short term situations or the short term losses, like temporary losses, distract you from your long-term potential and the long-term benefits from investing. Okay. That's one of the problems with most people now. Okay. They see what's happening now, and they see the market pulling back now because of inflation and interest rates getting ready to rise, that they're like, oh, okay, now things are rocky. They don't want to invest anymore because they see the red. Okay. I got a couple tips for that. So if you having trouble with that and you don't like seeing your account go down or be negative, just don't log into the account. Don't look at it. All right. Don't look at it. Just let it keep doing what it's doing. Keep your investments on. Keep your automatic investments on, your automatic payments every month. Keep putting money in it every month. And then next thing you know, next few years, you'll see that account start going back up. All right. And you didn't really have to do anything but stop looking at what's happening right now. And then next, just think long term. OK, this is a long term game. Warren Buffett he got majority of his wealth after the age of 60. I don't think most people know that. Majority, more than 60% of his wealth. Actually, I think it was more than 75% of his wealth came after 60 years old. From just long-term investing. I don't think most people know that. Okay. So you just have to think long-term. You have to be in it for the long run. That's when you win. Okay. The short term is not when you win. All right. Long-term is when you win. Leanne, you're welcome. Benyacita, you're welcome. If you want to learn more, if you want to, join my specific program, make sure you tap the link in the bio and join our group. All right, so your thoughts on VOO, QQQ, and Tesla. Hoshaya, what's up? How you doing? Great question. VOO, I love. That's the S&P 500. So I mentioned that earlier. Okay, the S&P 500 is going to do wonderful. QQQ. So QQQ is it tracks the NASDAQ. So that's another index. So the S&P 500 is an index. QQQ is an index. Or it tracks in the NASDAQ index, which is the top 100 tech companies. Okay, that's different from the S&P 500. I like QQQ as well. Okay, again, you got to think long term about this stuff. It's not a short term game. It's not a short term game. If you believe in technology and you believe technology is here to stay, which if you just look at the world that we live in right now, it's run by technology, and it's only going to be even more about technology in the future, then you have nothing to worry about. You have to think long term. Okay, same thing with Tesla. Tesla is the future. It's electric cars. Okay, there's already a bill out on moving towards more electric cars, less gas motored cars, right? By 2025, as a matter of fact, we want to have 30% of the cars on the road be electric. Okay, that's a big move. Tesla is the biggest brand that's doing that. If you think that's going to be around, then you have nothing to worry about. But you have to be long-term focused. You have to think long term. Okay. So great question though. Could you please go over the VOO and SPY ETFs explanation? Yeah. So the thing that most people get confused between VOO and SPY is that they are exactly the same thing. The only difference with them, VOO, for example, is created by the company Vanguard. We all heard of Vanguard. Okay, big company, one of the has the most assets under management, or at least the top 3 assets under management. Okay, if you don't follow me already, make sure you follow me. Top 3 assets under management. Assets under management is basically how much money they have invested. Okay, they have hundreds of billions of dollars invested under Vanguard. SPY is created by a company called Spider, SPDR. SPDR, okay, that's created by Spider, another company with a bunch of assets under management. They both track the same index, which is the S&P 500. So they are the same thing. They're going to have the same 500 companies inside of those ETFs. Okay, what you don't want to do is buy VOO and then buy SPY. You basically over diversifying. Okay, you're basically getting the same 500 companies. Okay, with with the same index. You shouldn't do that. Okay, you only need one of these, either buy VOO or buy SPY. VOO, I know for certain, has the lower expense ratio, which is about 0.03 the last time I checked. Okay, so that means it's going to cost less per dollar that you put in. Okay, so if you put $1,000 in the VOO, it's only going to cost you about 30 cents. Okay, per $1,000 to invest in the VOO, which is what makes ETFs so great to invest in. They barely cost anything. They barely cost anything. 0.03%. That's 0.0003. Okay, on your dollar. All right, so great question. Those are the same ETFs. I hope I cleared that up, Evelyn. Hope I cleared that up. Those are the same ETFs. You really only need one. VOO has the lower expense ratio. It's going to cost less to invest into this. All right. Benyusita, how much money do I need to start an investment? I'm 37 years old. I'm running out of time. All right. So this is all going to depend on your plan. All right. Depends on how much that you want to retire off of, or how much you think you will need in retirement. So one of the calculations that you can do is take your annual income. Is take your monthly expenses, multiply it by 12. That's your annual expenses. And then multiply that by 25. That's going to give you like a general number. So whatever number that is, that's how much you need to invest. And then what you need to do is go to an investment calculator like the Dave Ramsey investment calculator. Just type that into Google. Okay, and then start playing with that. Put in your age, 37, and see how long. Put in your age of 37 and to 67 years old. That's like average retirement age. That's about 30 years for you. And then put in a dollar amount, how much you can afford to invest each month, and see what that turns into. If it's close to the number that we did earlier, your retirement number, okay, then you're good. Just keep investing, right? I highly suggest S&P 500, something that's going to give you broad access to the entire market, and that gives you about 10% per year. All right, that's really good. But it all depends on your goal, what you want to do, what you want to accomplish, and how much that you want to live off of in retirement. Okay, that's the big thing. But if you just want to get started, if you just want to start investing, you can start with $50 a month, $100 a month, $25 a month. Okay, whatever you can afford, just to get started, get the ball rolling, and then you can increase it over time. Okay, I hope that answers your question, Benyisita. Jamila, what's up? What's up? Yo. Brother, would you say that SOXX is worth investing? SOXX. Okay, this is semiconductor ETF. So this is a play. All right. So there's a difference between investing versus a play. So what I mean by that is y'all getting some gems. I'm giving y'all some knowledge right now. So what I mean by that is when you invest, drop that skincare. Yo, I'm really about to get brand deals with some skincare and some beard companies. Y'all watch out. All right. Thanks, Jamila, though. I appreciate you. So this is a play. So what I mean by that is a play is basically like something that's not necessarily long term, but because of the environment, the current environment of our government and where everything is going, all right, it could potentially make you a lot of money in the shorter term. Okay, with the semiconductor industry, it's backed up right now. There's shortages. That's why inflation is so high. It's a lot of things that's backed up. It's a lot of companies that have shortages that aren't able to create these semiconductors. So there's a lot of pent up demand for these things. Now, some of the ETFs or some of the companies that's inside SOXX, the semiconductor ETF, right? They could benefit from that, meaning that they can make a lot of money from that pent up demand, which would drive that ETF up as well. Because if the company performs well, that's going to drive the price of the company up as well. And because those companies are inside that ETF, remember, an ETF is a basket of stocks, a basket of companies. All right. A basket of companies. Those companies will affect the price of that ETF, and the ETF will go up as well. So yes, it's a play. Is it a long-term play? I don't know. So that's something that you have to decide for yourself. Are you willing to take that bet? Do you know when to get in and when to get out? What's your plan on when to get in and when to get out? Okay. Is there a certain dollar amount that you want to make before getting out? All right. What is your plan? So with plays, you definitely want to have a short-term plan of when you want to get in and get out, but so that you can make your money and then put that money into something else. So like what I would do is, if I wanted to make that play, I would put money into SOXX. I would let that play out. That's probably going to take a couple years because of the shortage and inflation and all that type of stuff. I would let that play out, right? Make my money from that. Let's say it goes up, I don't know, 50%, 100% over the next 2 years. You just made 50%. You just made 100% of your money in 2 years, or 50% per year. I would take the earnings from that and then put that into my long-term strategy. That's what I would do. Okay? That's what I would do. So, I hope that made sense. I hope that answered your question, Hoshaya. You make things easy to understand. Thank you. That's what I pride myself on. I pride on making things simple so that people can take action. I want everybody on this live to take action. Okay, so the things that I teach you, the things that you learn from me, go out and take action, right? Go do some more research and then take action. Make sure what I'm talking about is what I'm talking about, and then go take action. All right, I don't want you to just take what I say and then go do it immediately. Nobody should do that. Go learn from me, then go learn on yourself, do your own research, then take action. Okay, that's the process. That's the process that I want everybody to go through. Okay, don't just listen to somebody on TikTok, Instagram, YouTube, whatever, and then go do it immediately. Nah, learn from them. Take that information, compare it to the stuff that you learn and you research, then take action. That's called research. That's called study. Okay, that's called taking the steps towards, taking that action. That's ultimately how you do it. All right. So if nobody else tells you that, okay, beware. Because if they just tell you, just listen to me, don't worry about that. I'm only like, okay, just beware. I'm just letting y'all know because nobody knows all the answers. And especially in the finance world, things change like almost every day in the finance world. Like, come on, every year, like literally every year, the numbers change, requirements change, limits change, rules change, bills happen in the government that's passed that changes everything. So, just do your research, do your own research after you get information from people. All right. So if you had this is probably my last question, y'all. Then I'm gonna have to hop off. Got like 2 minutes. Then I got like 2 minutes. If you had an extra 5,000 lying around, what stocks would you research and consider purchasing? So for me, I'm not much of a stock guy. All right. I'm not much of a stock guy. I'm more of an ETF guy. I like to just put my money into the ETF and invest. Okay. But there are companies that I like, that I think are the future. Okay. So for me, I'm always going to find a way to invest in the Apple, Microsoft, Amazon, Google, PayPal, Square, and Tesla. Okay, I think I named them all. Apple, Microsoft, Google, PayPal, Square, Tesla. Apple, Amazon, Microsoft, Google, PayPal, Square, Tesla. Y'all got those? I hope y'all got them. Okay. Amazon, Apple, Google, Microsoft, PayPal, Square, Tesla. Those are always like the first ones that I'm gonna put extra money into. All right. But notice those are quality companies. Like those are companies that's already, has a track record that's been performing well, that's going to continue to perform well. And that's also going to be like the future. Okay. Y'all see the moves that Apple are making. Y'all see the moves that Microsoft are making. Really, all these companies that I just named are making. So that's how you gotta think about not only like right now and the performance of the company and how well the company is performing right now, but also the future. Is this company gonna be able to be around another 10 years, 20 years? That's what you got to think about the things that you're investing in, because you're investing for the future growth of a company. You're investing into the potential of a company and what that company is going to pay you in the future. Not right now. Right now is not important. Okay, you're investing in the future, the potential of what that company is going to give you. Okay, so those are the stocks that I would do my research on and consider purchasing if I was a stock guy. Just to let y'all know. So y'all getting some more gems from me tonight. I hope y'all appreciate this. If y'all like this, double tap. If y'all like this, double tap. If y'all getting some value, double tap. We at 11 and a half. Let's get to 13,000 likes, y'all. Y'all can do it. Let's get there. Let's get there. Appreciate you, Oshaya. Thank you so much. Appreciate it. Let's get this last question, y'all. Oh, somebody wrote it in the comments. Quick. Somebody got it in there quick. All right. So if I was making 900 every 2 weeks, what percent of that would you recommend saving? So that's a simple question. And I love this question so much because a lot of people, when it comes to money, it's really about having a plan and knowing what to do with it before you get it. The problem is, or the issue is, most people, they spend their money before they get it instead of, allocate their money before they get it. There's a difference. You spend it before you get it, meaning that you have I don't know what I'm doing. I'm just going to buy. I'm just going to get this and get this. I got to pay this off. I got to do that. Instead of allocating your money. Okay? Allocating it and putting in positions, for your future, for your present, and for things that you bought in the past. So here's what I would do. Okay? I recommend, so I personally do a 60-10-30 plan. 60-10-30. What is that? 60% goes to my needs, my bills, my everyday expenses. 10% goes to my wants. So if I like some shoes, if I like a shirt, if I want to go take a trip, go on vacation, something like 10% goes to that. And then 30% goes to saving and investing. All right. So most people are not there yet to be able to fit everything in a 60-10-30. Okay. But that's how I would split it up. 60% of that. So 60% of 900 is, what's that? $540. Okay. Then I would take 10% of that, which is $90, and put towards something that I want every 2 weeks. Okay. Then I would take the other 30%, $270, and put that towards my saving and investing every month. My long-term investing, my business, something, real estate, whatever the case may be, I will put that towards that, or just save it and get ready for that opportunity whenever that opportunity comes. All right. So that's how I would split it up, just so I have specific places to put my money and know exactly where my money is going. We have to get in the habit of being able to manage our money the right way so that our money is not controlling us. A lot of us are controlled by our paychecks. A lot of us are told what to do based on how much money we make, instead of telling our money what to do and then choosing what to do based on what we get, or the money that we get. Does that make sense? Y'all let me know in the comments. Does that make sense? Double tap, double tap. Let's get it to 13,000, y'all. We at 11.8 right now. Let's get it to 13,000 likes. So I hope y'all got that breakdown. Okay, that's something that you could try. If you're not quite there, okay, I would just do 80-10-10. 80-10-10. 80-10-10. I would do 80% needs, 10% wants, 10% saving and investing. Just to get started, just to start getting in the habit of saving and investing and managing your money the right way. Okay, the next step to that is what I call the swipe stripes method. For those that have been with me for a while, y'all know what I mean by the swipe stripes method. That's a whole nother class. That's a whole nother live. I talked about it before, but I'll go in depth a little bit more later. But that's another way to manage your money, and then, another way to save on top of that and get a whole bunch of other benefits that come with that. All right. So if you don't follow me already, make sure you follow me. All right. I appreciate y'all so much. Let's see what time is it. I'm 5 minutes over, y'all. All right, let's do one more. This is my last one. What are your thoughts on life insurance and finance? I believe life insurance should be simple. Okay, you don't let life insurance be an investment. Let life insurance be life insurance. Okay, some people will try to sell you on life insurance as an investment. Nah, the best investment is an investment account, like actually investing into the S&P 500. Okay, so I believe in term life insurance is the most affordable. It's something that's flexible. It's something that everybody can get if they qualify, right? And that's what most people should have, in my opinion. Now, if you do your own research and you find something better, something that better fits you, because it really depends on your situation, right? Your family, what's going to benefit you the most in the long run, right? You have to make that decision. But me personally, I believe term life is the greater decision for most people. But you have to remember that with term life insurance, you need to invest along with that. Like, you have to. Like, it's non-negotiable. If you buy term life insurance, you need to be investing, because you need to replace the life insurance with your investments, right? With the wealth that you build through your investment account, because the term life insurance is going to go away at some point, because it's a term, right? It's only a certain amount of years, 20, 30 years, term life insurance. So you need to be investing over those 30 years to be able to be what's called self-insured and have as much money invested as you would if you would have got as you would have had with the amount of coverage on your life insurance. Okay, so that's what I believe. That's my thoughts on life insurance and finance. Okay, so let me know again, how many of y'all want this replay or would like to see the replay? Let me know in the comments before I get out of here, just to make sure that I can save this and put this somewhere so that y'all can see it later on. Because I think it's I think this was a good live. I think it's a good live. Let's double tap, y'all. Double tap, double tap. I agree. Thank you. I appreciate it. You're welcome. You're welcome. You're welcome. Appreciate it so much. Double tap, y'all. If you got some value out of this, if you learned something, if this was a great class, if this is a great live, please show me love. I appreciate it so much. Let me know that everything that I talked about was simple, you was able to grasp it and understand it, and now you'll be able to put it into practice for you, your family, and ultimately to help you and pass this on to somebody else, right? Hopefully what I taught you, you're able to pass it on to somebody else. You're able to teach somebody else and just relay the message, because a lot of people make this stuff complicated. A lot of people say big words and try to do all these things when really it's simple. Really, it doesn't have to be that complicated. So my goal is to simplify it and make it make it easy for you to understand, so that you can give it to other people, so that you can teach other people the information that I relay to you. All right. So I appreciate y'all so much. All right. I see a lot of people saying that they want the replay. If you want books that I recommend, join our group. I got a whole list of books that I read that I think everybody should read. Y'all make sure y'all tap in with me at the link in my bio to get inside of our community. We have over like 1,700 people in there right now. We have a money challenge going on. We got a bunch of great things going on. A lot of stuff. So I appreciate y'all again. Thank y'all so much. Let's get it to 13,000 before I get off. We're at 12.7. Just double tap to end this live. I appreciate y'all so much for tuning in, for staying on with me for this hour. That's a long time to be watching somebody on live, really. So I appreciate y'all for sticking with me. That means so much to me. And I'm just grateful. You should create a budget planner. I definitely purchase it. I have a budget planner. If you go to imyourmoneycoach.com/cash flow planner, okay, you'll be able to get that. www.imyourmoneycoach.com/cash flow planner. Okay, all it is a spreadsheet. You'll be able to write down all your expenses and stuff like that. Okay, it's a very great tool. I made it a couple years ago, actually. So, but it's still helpful. All right, y'all. So I'm gonna keep this replay. Y'all saying y'all want the replay, so I'm gonna keep it. I don't know if I'm putting it up on YouTube or keep it exclusive to my group. If you want to know, make sure you join our group at the link in my bio, so that you'll get access to all this information. So everybody in my group knows when I go live, when I drop new stuff, when I drop new videos, all that. So if you want to stay connected with me, I think that's the biggest part for me. I don't know what TikTok is going to do, if they ever shut down my account, if they ever block me from ever going live or something like that. My group is the best way to still have access to me, and you'll always be connected to me no matter what. So consider joining our community. I think you'll like it a lot. So again, I appreciate y'all. Y'all be good. Y'all be blessed. And remember, believe in yourself, invest in yourself, and most importantly, love yourself. Peace. Y'all be good.